All right, everyone. Good to see you. Lots of friendly faces today. Today, I'll be talking about how to ensure that your mortgage is tax deductible. So there's lots of cool tips and tricks that you can use in order to understand this better. I think it's a really important key to anybody who's investing in real estate, investing in anything. And I'll have a couple of stories and examples to share that can help put some ideas and thoughts into your heads on how you can best structure your personal residence mortgage to make it tax deductible. So let's get into it. Welcome, everyone. Thanks for coming out. We'll be talking about a few different topics today. Using your home equity, what is a HELOC or home equity line of credit, the difference between good debt and bad debt, investing in real estate, investing in private lending, what are exempt market dealers, investing in stocks. So basically, if you have a line of credit and your mortgage is now tax deductible, what can you invest into? And then just comparing different options to help make decisions. I've had a lot of clients ask lately, okay, I have a home equity line of credit. What should I do with it now? To be honest, a lot of clients for the last couple of years have really just put the brakes on and said, I'm not going to invest in anything. I just want to see what happens with this market. Lately, we've seen more people start to get back into wanting to invest their capital and do something again. So starting to see a bit more activity in the marketplace. And I think that it's important to just have a bit of a rehash on what the different options are, different opportunities would be to look at investing. So first of all, it's really important to be understanding that using your home equity is a great tool and a great way of building your wealth. A home that's fully paid off is not really working for you. So if you do have a home that's fully paid off, your only real return on owning that home is just the appreciation now. You don't have any return from paying down a mortgage, and you definitely don't have any return from being able to access that equity and invest it. So one of the big questions is, well, how do you grow your wealth and how do you build it over time? One of the ways to do that is to basically increase your investments and then pay down that mortgage. And I think at the end of the day, a lot of people get into this situation where they're just not sure which one to do. Should I increase my investments? Should I pay down my mortgage? Which one is the best? Obviously, if interest rates are really high and the investment returns are low, then you probably should just pay down the mortgage. And that's frankly what a lot of clients have been doing for the last couple of years. Now that rates are starting to get down to a more manageable point, people are starting to look at different investments again. And this is where people are starting to think, well, what should I be doing? Now, instead of doing just one of these, you can just do both at the same time. You can actually increase your investments and pay down your mortgage. And the way to do that is to use a home equity line of credit. So let me show you and kind of articulate how this works. The most important thing is first getting a home equity line of credit. And there's a couple of keys that you need to know. A home equity line of credit is only available if you have if you're borrowing 80% of the value or less. And on that note, of this total product, so if you're borrowing 80% of the property value, only 65% of that can be on a line of credit. So if your home is worth $1 million, the maximum line of credit you can have is $650. You can still borrow a total of $800, but that line of credit maximum is only $650. Now, if we give you an example here and talk about how a home equity line of credit could work, let's say that you had a home worth $500,000. And so probably not in Vancouver, maybe a condo, but you had a home worth $500,000. Generally speaking, you would want to get a home equity line of credit set up. If you look at it, let's say that you had a $225,000 mortgage outstanding. What you could do is you can get a line of credit for $175,000. So that means that the total amount of credit available to you is actually $400,000. So that's 80% of the property value. Now, the cool thing is if you get a readvanceable line of credit, and it's very important to understand there is a difference there. Not every line of credit is what's called readvanceable. If you get a readvanceable line of credit, that means that as you pay down the mortgage, the line of credit limit will actually slowly increase. So paying down that mortgage means that now that money moves over to the line of credit component, and that line of credit limit will now go up because you can always be borrowing a total of $400,000 in the facility. So this is a great strategy and great way of being able to then say, okay, well, I don't have to make a choice of whether I invest or whether I pay down my mortgage, because what's going to happen is by paying down the mortgage, the line of credit limit will increase. And then you can borrow that money on the line of credit to then invest. And the really cool thing, what I'll talk about in a little bit, is that whenever you borrow money to invest, the interest portion of the payments is also tax deductible. So you're basically transforming your mortgage and you're paying down the non-tax deductible component, reborrowing out the tax deductible part, and basically transforming your entire mortgage into being tax deductible. A couple things I have to note. The government did make some changes. So if you're borrowing over 65% of the value, then it's not dollar for dollar that you pay down on the mortgage and the line of credit limit increases. So they changed that a few years ago. Over 65% is not quite dollar for dollar. It's close, but it's not quite. And that does mean that you're not quite able to get access to every dollar you've paid down on the principal. But if you're at 65% or less, then every dollar you pay down on your mortgage will increase the line of credit by the corresponding amount. Most lenders, by the way, will let you have different mortgage and line of credit components inside of the product. So some lenders, you have 3 mortgages and 3 lines of credit. Some lenders let you have 5 mortgages and a line of credit. Some let you have 10 facilities. Lots of different options to split this up and have multiple different portions inside of the facility. And so this is a really great way of being able to borrow money. And let's say that in the future you want to do $100,000 for down payment on a rental property. You could borrow that, and then you can convert that into a mortgage term. You get a mortgage rate on it when you do that. And you still keep the extra money available to you on the line of credit too, that you haven't locked in or borrowed yet. So you can have segments, and then it makes it really easy for you to track it. Now, I want to give you a couple of examples to kind of paint a picture for some of the things that that we will bring up to customers as different options. So I remember I had a client a few years ago who she got into a car accident, and so she had a fair bit of money. And what she wanted to do is she wanted to put the 20% down on her residence, and then she wanted to do the other cash that she had was going to be down payment on a rental. And what we ended up doing is I said, well, why don't you take that settlement and actually put more down payment on your residence? So we're going to take that extra $200,000 from the ICBC settlement. We're going to pay down the mortgage even further. And then you're going to have to get a line of credit so you can reborrow the $200,000 back out, and then borrow that and then invest it. And you're going to be now using that for the down payment on the rental property. And when you do this, now you'll be able to write off that extra $200,000. So effectively, she's still borrowing the same amount, because instead of getting a larger mortgage on the residence and then a mortgage on the rental, she had a smaller mortgage on the residence, but then she reborrowed back out that $200,000. So the same amount is still owing. But now out of that mortgage, $200,000 of it was tax deductible. Now, at her tax bracket, she wasn't in a high tax bracket. She's probably in a 30% or so tax bracket. But at interest rates at the time, which were probably around 4%, on $200,000, basically you're writing off 4% interest on $200,000, which is $8,000. And at a 30% tax bracket, that means that she'd be saving about $2,400 a year in taxes. A pretty significant amount, especially when you consider that you're going to be saving that amount over 30 years. And of course, slowly over time, that amount is going to decrease as you pay down that mortgage. But it's a pretty significant amount of tax savings when you consider that you'll be able to do this over a very long period of time. I actually just had a client recently, a couple of weeks ago, who is buying a house in Vancouver for about $3.5 million. And what we ended up talking about was, well, instead of getting a mortgage on the property, he had a lot of unregistered investments. And so we said, well, why don't you just get a line of credit on the home, and you can unwind those investments, pay down that line of credit down to zero at some point in the next coming months. And then you can reborrow all of that money back out, put it back into the investments. And the numbers on this are quite staggering, because when you look at it, the tax savings of about $2.3 million at 4%, it's about $90,000 a year that he's able to write off. And then the tax savings on that is closer to about 50% because of his tax bracket, which is about $45,000 per year in tax savings. Obviously, that's an extreme example, but it is incredible how much money you can save on the tax component when you do this. So it's a really, really cool way of setting this up and structuring it, and something that is a lot of people are very interested in doing. As a quick question here, so and that is asking, can you change to a readvanceable mortgage at the renewal time, or are you stuck until the mortgage is paid out? So you can do this at the renewal time. So when your mortgage comes up for renewal, you can then try to requalify to move it into a readvanceable product. Now, these products are harder to qualify for. So just a note that it is more difficult to qualify for these types of mortgages. And not every lender has it. So some credit unions, for instance, just don't have a readvanceable product. Typically, these are available through the banks and not something that is available through most credit unions. So just something to keep in mind. Now, the reason that you want to start to consider this is there's a difference between good debt and bad debt, and your objective is usually to minimize the bad debt while using but not abusing good debt. So bad debt is depreciating assets, anything that will go down in value. So typically, not always, but typically buying a car is usually a depreciating asset. Consumer goods is almost always a depreciating asset. So in general, buying these types of things usually means that you're losing value. Good debt would be anything where you're buying something that appreciates in value. So a real estate or stocks and things like that will go up in value would be considered good debt if you're borrowing money to buy something that goes up in value. And then what's even better is when that is tax deductible debt. So if you're able to structure it in a way where you're able to write off the interest portion of the payments, buying real estate or buying stocks, of course, this is where you want to be. And the thing to look at here is, yes, you're going to basically be having an asset and a liability on each side of the fence, but the net worth is your goal. So you want to be able to grow your assets and, of course, minimize your liabilities. And over time, your objective is to be able to build the assets at a faster rate than the liabilities. Trying not to get straddled with credit card debts or anything like that. That's not the strategy that we like to employ here. You want to be generally borrowing against your home when you do this, because borrowing against your home is one of the cheapest spots that you can borrow money from, not using consumer credit card debts, etc. That's where, borrowing against your home is usually the cheapest way to do this. And it's very important that you structure your mortgage properly to save in taxes. And so the way that it works is effectively you're making your mortgage payments, you reborrow the principal that you've paid down, you invest, and then you're saving on your taxes when you do so. It's not that complicated, and there are a lot of circumstances where if you have other non-registered investments, you can pay down your mortgage and then reborrow back out and then use that to invest. And so that's a common strategy that we recommend to a lot of our clients to think about and consider. And it's it's a very valuable tool, but you do need to make sure that it's set up properly, and there's lots of things that you need to look at. Now, here's the key. It's all about the use of funds. So a lot of people get this confused and mixed up here. We've had clients where if you're borrowing against your personal home to buy an investment property, then that is generally tax deductible. But we've also had it before where a client is turning borrowing against a rental that they own to buy their own residence. That use of funds is not investing. When you borrow money to buy your own personal residence, in Canada, you don't pay capital gains on your personal residence. It's not considered an investment, and so you don't pay taxes on it, but you also don't get tax treatment in a beneficial way either when you buy your own home. So it's really important that you don't look at it and say, well, I'm borrowing against a rental, so I should be able to write it off. It's always the use of the funds that determines the eligibility of being able to write it off. And so the use of funds, consuming is not tax deductible. This is an important feature. So if you're borrowing money to buy food, buy purses, etc., that would not be tax deductible. But if you're borrowing money with the expectation of generating income, then that would be considered tax deductible. I always mention, whenever you're looking at doing something like this, always make sure you get accounting advice. There may be reasons that you may or may not be able to write off something or claim something. For instance, if you're borrowing money to put into registered funds, then that's typically not allowed. Because you're already getting a tax break when you're investing into registered funds like RRSPs and TFSAs. But in general, when you're investing into to other things that are not registered, typically you can write off the interest portion of those payments. And then what you're trying to do is you're trying to create a spread. So if you can invest at 8.45% and you're borrowing at 8.45%, so typically a line of credit rate is about prime plus a half, and right now prime is 4.95. So if you're borrowing at 5.45, and then you can find an investment opportunity at 8.45, you're making 3% almost out of thin air. You're not even really using cash. You're just using your home equity to create an additional income. And if you think about it, if you have a bunch of accessible equity in your home, let's say $500,000, and you borrow that money at the current prime rate and invested it into something that generates a higher rate of return, you're making a net spread of 3% on that money. And 3% on 500 grand would be 15 grand a year of income that you'd be earning just by borrowing money and then reinvesting into something else that's safe, that earns you a decent rate of return. And there's a reason I picked 8.45. First of all, the math is really easy. It's just 3% higher than the current line of credit rate that most people get. But secondly, I also picked this number because, generally speaking, most mortgage investment corporations typically are at a annual return of about 8.5%. Some might be 8, some might be 9, but 8.5% is kind of a general expectation for a return by investing in a MIC. And I will get into what a MIC is in a little bit, but it would be considered generally a relatively safe investment. I think obviously when you start to push the expectations for what you can get on your return, you also generally increase the amount of risk that's associated with generating those returns. And so interestingly, when I was actually updating these slides just before this presentation, and I went through this, the last time that I did this in early 2024, the line of credit rate was 7.7%. So you can imagine that a rate that's almost 2% higher, it makes it a lot harder to justify this type of strategy. In this type of climate right now with the Bank of Canada, we're still expecting about 0.5% in cuts, which means that if you're borrowing money in a line of credit, you'd probably be around 5% on your line of credit for a while anyways, and who knows where the interest rates are heading in the future. But it does make it a little bit easier to find investments where there's enough of a spread over and above 5% where you can make money. A little bit harder when the interest rates are, were quite high before, and the line of credit was going to cost you 7.7%. Well, now you have to find an investment where you're getting almost a very conservative 11% return, which meant a lot of people weren't really looking for that. But I've had a lot more inquiries in the last few months about people wanting to employ this strategy, and that's why I decided to do this webinar again, because I think a lot more people are thinking, you know what? Now that rates have come down enough, maybe it makes sense to start to look at different opportunities and getting a line of credit set up, creating that tax deduction, and then figuring out what to invest in. So I do want to talk a little bit about what to invest in, because that's also the next step is, okay, great, I have a line of credit, but what do I do? What do I do with the money? Where do I invest the money? There's a couple of different things to look at. One is, of course, investing in real estate. Obviously investing in real estate still has its pros and cons. And I found that less investors have been active in the last couple of years, but I felt like starting a little bit in 2024, but a lot in 2025, more investors are getting a little bit more active looking at properties again. And sometimes a market that's a bit softer is actually a really good market as an investor, because you can start to sniff around and find opportunities. I have a couple of investors that actually have some properties tied up that are foreclosures, and some of the prices that we're seeing. I have one client buying a property that's quite a bit underneath the appraised value. So there's lots of different opportunities where you can find good properties that you can get a good deal on, and so sometimes it's good to keep your eyes on the market. And of course, having a line of credit available, sometimes it even gives you the ability to just write a check and close on it very quickly. Provides you with an opportunity to close on a deal quickly that another buyer may not be able to, because they might have to write subject to financing on an offer, etc. You can invest in stocks, of course, investing in growing companies. I've always been more of a proponent of investing in real estate, but I also think that you should be diversified. You would have done quite well in the last couple of years if you had a diversified portfolio instead of everything all in real estate. So I do recommend that you do try to keep yourself, relatively diversified. And then, of course, there's other investments as well. I'll talk a little bit about private lending and private equities in this presentation. And There are, of course, a number of different things you can invest in, but these are the core ones that I would say make up the bulk of what people are asking for more information about. So getting into it a little bit, why invest in real estate itself? Leverage is one of the most important aspects of investing in real estate. And that's because when you buy an owner-occupied home or a second home, you can do as little as 5% down. And if you're buying an investment property, you can do as little as 20% down. Now, why does this matter? It's because when you are getting leverage, you're getting a higher rate of return on your capital. So let's look at what the returns on your capital are when you're buying an investment property. There's cash flow. And you know what? I again went through this slide and updated it a little bit. Most of the deals that I'm seeing are actually with 20% down are actually negative on the cash flow. So it's very hard to find properties that will cash flow positive or even neutral. Most of them are actually negative on the cash flow. So I actually updated the slide to represent a negative cash flow to look at what the returns are if you were negatively cash flowing. This is the big one. And this, of course, can vary significantly. But the reason I have 15% here is that in general, at least for my models, I usually use about a 3% annual appreciation on average. And usually what happens in real estate, it's 0, -1, +2, -2, +15 in 1 year. It usually has these boom years that come out of nowhere that then you stretch it over that period of time, and that is the average over that period of time. So I like to use about 3% annual appreciation. Now, the reason we're getting 15% return on investment from appreciation is that if you put 20% down, so 1/5 of the property value, that means for every 1% of appreciation, your return on investment is 5 times that, or 5%. So if it's a 3% annual appreciation, that means you're getting a 15% return in your money. So it's a fairly significant return when you look at it that way. To paint a picture for you, let's say that you bought a property for $500,000, and let's say the property value went up from 500 to 550, so it went up by 10%. Remember that return that you earned is based off of your cash that you put into the deal. So if you bought a property for 500 grand, you probably put $100,000 down or 20% down. That means that if the property value went up by 50% or 50,000 on your $100,000 investment, you've made a 50% return. So even though the value went up by 10%, your return on an investment is actually 50. So this leverage aspect is really important when you're looking at your returns investing in real estate. And then the mortgage paydown, very rate dependent, but in general, if you were to buy that property and buy a property for $500,000, get a $400,000 mortgage and $100,000 of equity put into the property, your tenant would probably be paying down between $5,000 to $7,000 per year on the mortgage. That means you're getting about 5 to 7% return on your $100,000. So if you look at all the returns from all different angles, cash flow, mortgage paydown, and appreciation, generally owning real estate will generate about a 16 to 22% return over an extended period of time. And of course, it's not every single year like clockwork. It's generally, the appreciation is where the bulk of it comes from, and that comes in batches usually. Now, private lending is an interesting one because you can also be the bank. And I've actually had a lot more clients being inquiring about this and being interested in this. And it's because the interest rates went up in the market, but guess what also happens? That means that the private lending rates also went up. And so investors were able to get a higher return by lending out their money as a private lender than they were before. Because generally speaking, when you're a private lender, you usually just tack on a certain percentage over and above the current interest rates. And so no matter what, you always got a surplus over and above current rates, which protects you from being in a situation where you're not making as much money as you should. So some examples of deals that we've done for investors. We've done short-term deposit loans. So an investor or a client needing short-term money to do a deposit on a purchase, but all of their equity is tied up in their current home or tied up somewhere else. Helping investors do flips, development deals, land deals, first mortgages, second mortgages, just standard deals. And then, of course, a lot of these deals are short-term loans by nature. So I've done separate webinars all about private lending, so I won't go too deep into it. But just as a general kind of concept, you could get a line of credit and then use that to do private lending, which a number of our clients actually do. Another option is to invest with exempt market dealers. So this is also called private equity. And this allows you to be a small part of a bigger deal. And I'm actually finding that for many different reasons, people are getting more involved in bigger deals and more interested in this. One of the big primary ones is that CMHC insured multifamily financing. So if you're getting 5 or more units, there's a lot of government incentives to have lower interest rates, longer amortizations, higher loan to values, all for multifamily buildings, which you as an individual wouldn't access if you're just buying a one-off condo. But if you were one person out of 100 buying a 100-unit building or being an investor in a 100-unit building, then you can get access to much better interest rates and financing terms. And so this is where you're not having to do all the work, which is nice, and you're just putting up cash and being an investor in a project. There's a couple of different things to think about. Some of the pros of dealing with private equity is it's more passive, it's hands-off way of investing in real estate. You're not getting the financing, so you don't have to get a mortgage. So I know all of you love supplying documents to get mortgages. I know you love it, but in these cases, you're not the one getting the mortgage, so you don't have to deal with it, which is great. Usually, and it depends on the investment fund, but some of them have a $25,000 minimum investment. Some of them might have lower than that, but most have this much or higher, I find. So the minimum investment is relatively low. You can usually diversify your assets by asset class, geography, and a number of different things. And then some of them are also even RSP and TFSA eligible if you self-direct your funds through something called the Olympia Trust, which I won't get into today, but lots of ways of being able to use RSPs and registered funds for these. Some of the cons are that the investments are illiquid. You're not in as much control of determining when you can get your money out. You do have to read the agreement and see what options you may have to get your money out, because you may not have a lot of options. Sometimes they can take longer than expected to exit if there's delays with the investment. And they can be considered higher risk in some cases, because the deals can just be, in general, much bigger. So there's a number of different things to look at from that perspective. So the private equity is not just for people in suits. It's available for eligible investors, accredited investors, and it's designed to provide a passive, hands-off way of investing in real estate. So if you do want to learn more about that, I do have contacts that are interested that are in private equity. Actually, the session that I was at right before this, as many of you know, there's new zoning bylaws which allow multiplexes to go up to 6 or even 8 units on pretty small plots of land in Vancouver and other areas. And so one of the groups that I was just at a little event with are now starting to really get that going. They have some 5, 6, 8 plexes that are starting to build. And they're, of course, looking to raise capital for those projects, and the returns seem enticing. And of course, it's very early stages, so who really knows exactly? And I haven't gone through any due diligence or looked into that just yet, because we just met. But there's going to be a lot more opportunities like that, I think, in particular on the multiplex side. I think we're going to see a lot more companies popping up and presenting opportunities, and they'll need investor capital to be able to do that. Really interesting, by the way, anybody that has a home in Vancouver that wants to be a part of that but doesn't have equity, and most of their equity is tied up in their home, they've been partnering up with people, so they'll actually buy your home, and then they'll close on your home, and then you can roll some of your sale proceeds of your home into the project as a limited partner, and you can be basically an investor in the project of building that 5-plex or 6-plex on your own home, which is kind of cool. So I think that's a cool concept, and I think we're going to see a lot more of that kind of stuff in the next couple of years for sure. Now, of course, you don't have to invest in real estate or any of these. You can also invest in stocks, if you really want to. You can invest, or you can invest in real estate. So there's lots of different things that you can look at, but investing in stocks is obviously a very different animal. You're up and down and all around, all over the place. If you've been investing during the whole tariff situation, then you've probably seen a lot of ups and downs. And hey, sometimes you do win, but a lot of the time it can be devastating. And it's actually interestingly, I was at this event just a little while ago, and one of the guys that was there is now becoming a realtor, and he has been a day trader for some time, and he's getting out of trading commodities and getting into real estate, because in real estate, you can invest in real estate, you can sit back, relax, and you can watch your investments grow. So, and yes, I have used that photo for years and years and years. No, it is not my cat, but I wish I had a higher quality JPEG, but I just love this photo. I think I actually started using this photo probably about 13 or 14 years ago in some of my very early PowerPoints. So I decided to revive it for today's presentation, just to bring it back up. So yes, investing in real estate is obviously one of the things that we believe in a bit more than investing in stocks. But of course, there's lots of things that you have to consider when you're choosing. One of the things that I like to look at are the differences between all of these. And so if you're looking at qualifications, investing in real estate, you do have to qualify. Being a private lender, you do not have to qualify. Being an exempt market dealer, you're not qualifying for a mortgage, but you do many times have to qualify as a accredited investor. So there are different thresholds that you may have to meet in order to be able to do that. And investing in stocks, you don't have to qualify. The average total return on investment, obviously these are numbers that are very loose, but generally speaking, owning real estate is between 16 and 22%. Private lending, usually the rate of return is between 6 and 12%. Obviously, it can be higher than that. Some of the deals that we do that are higher risk are 15 or even 18%, but most are between 6 and 12. Exempt market dealers, sometimes it's as low as 7%. For really safe investments, and sometimes it can be 30% if it's a real estate development deal that is expected to have a higher return. Stocks generally are 5 to 10% fairly consistently. On the cash flow side, I'm using long-term averages here. Usually, cash flow on long-term real estate is usually closer to 0 to 4%. Private lending, all of your return is coming from cash flow. So whatever your return on investment is, you're getting that in cash flow. And exempt market dealer situations, you're usually not making money on the cash flow. Usually it's a capital return at the end, depending on the investment, but some of them will have some kind of cash flow built into it. And then stocks, you may be buying a stock that is a dividend issuing stock. So, you might be getting 3% to 6% annually in your stock. The term of investment, so this is a big one. Real estate, generally, you should be thinking about it long-term, 5+ years. Private lending, usually the terms are 1 year. Exempt market dealers, usually most of them are 3 to 7 years. There are some that are shorter, some that are longer. Really depends. And then stocks could be a minute to a lifetime. Really depends on your expectations. Now, payout frequency, generally speaking, you're getting cash flow on a monthly basis, but then the rest of it really comes from refinancing or selling. Private lending often is monthly, quarterly, or annual. So if you're doing your own private lending, then you're usually getting the money monthly. But if you're investing in a MIC or something else like that, then usually it's quarterly or even annual. And then exempt market dealers, sometimes it's monthly, but usually it's quarterly or at the end of the term. And that's typically how those are structured. And then stocks, of course, it really depends on the situation. Stocks usually or quarterly if it is a dividend stock. Volatility is important too. Real estate is probably medium. Real estate values will fluctuate. Private lending is fairly low risk as long as you're lending out low risk deals. So if you're not lending a high amount on a property in a major urban center, then generally it's fairly safe. Exempt market dealers are usually low to medium depending on the situation. And then stocks can be very volatile, can be all over the place. Real estate is generally low liquidity. Private lending can be medium. If it's in a MIC, if it's in a private lending, then it kind of depends if you think 1 year, but the money's locked in, is liquid or not. It kind of depends on the individual. Exempt market dealer usually is fairly low on the liquidity side, and stocks on the other side are very high liquidity. And then RSP eligibility. So real estate purchases, typically no. Everything else can be. Really depends on the situation. So if you really look at this chart, the most important key really is just to diversify. We don't think that you should be buying all stocks or buying all real estate or putting all your money in private lending. I do think that there's a different strategy for different people. I do think that in general, as people get older, they usually start to de-lever and de-risk themselves, and so that's where people start to get out of real estate and do more things that are more safe, like investing into private lending and things like that. What our clients are doing is, in general, they're reducing their payments and paying off high interest debts by refinancing. So if anybody's gone through a tough time in the last couple of years, now is a great time, especially if your renewal is coming up, to consolidate everything into your mortgage. If you have car loans and credit card debts, etc., get that all bundled up into the mortgage, lower your overall interest cost. Learning how to properly structure your mortgage can save you thousands in tax with the very simple changes. So that's another thing that a lot of our clients are thinking, maybe I should see if there's a way that I can save some money by restructuring my mortgage in a tax way. And then, of course, now we're finding that some more of our clients are starting to get access to capital with the expectation that they want to invest and they want to earn a spread on the interest on their interest costs versus the return that they're going to be earning in the investment. So more people are starting to do that. And of course, utilizing home equity to buy rental properties is still something that people are doing. I would say probably at a smaller rate and scale than people were doing it in 2021, of course, but people are still doing that, and I feel like it's starting to come back a little bit. But people are pickier and choosier with the type of property that they want to buy. They generally are looking for a deal in this type of market, which I think is the best way to be looking at. So I think if you don't already have a strategy, it's a great time to get your real retirement strategy in place, and we can help with that. Feel free to visit our website. We have more information about upcoming webinars. We have an investor survival guide, private lending package, and more frequently asked questions. So you can always book a consult with myself or Brian at our team. And then if you don't already have a copy of our book, Rockstar Real Estate Investing, then reach out, send me your address, like mailing address, and then we'll be happy to mail a copy of our book to you. And otherwise, that's all I have for today. I will answer some questions as well. So I'll go into the Q&A here. Okay. All right. So Williams has a question. I'm using the Smith maneuver presently and have borrowed from my primary residence HELOC for investments. As with any debt, the HELOC has interest charges. Where should the cash for interest paydown come from? My personal banking, some other investments, cash flow, other. So one of the cool things that you can do, and this is called, there's a terminology called cash damming, and this is a strategy that some people use where they take the positive income that they have from other investments to continue to pay down their mortgage, which then opens up more room in the line of credit. And basically what you could do is, let's say if you have a rental property, you could take the rent from a rental property, pay down your mortgage on your residence, which then means more room goes on your line of credit. And you can actually put and move your mortgage payments and put them onto the line of credit. So in theory, if you wanted to really ratchet it up, you could actually put all of your expenses into the line of credit and keep ratcheting it up, and take all the income and keep paying down the mortgage. So there are ways that you can kind of accelerate that and really grow the tax deductible component of it. It is something that's relatively, I would say it's relatively administratively intensive. So a lot of moving money back and forth, and that can be, relatively difficult. So that's something that you would want to consider. And if I talk too fast, there's lots to get through. If there's anything that didn't quite resonate, feel free to ask me a question, and happy to help with that. Okay, so how to pay the monthly interest charges on the line of credit? I mean, generally speaking, that would just be with your own cash. You could use some lenders like Manulife, for instance, will let you actually capitalize interest costs on itself. So it actually can act like a reverse mortgage. We can actually keep adding the interest to the outstanding balance that you owe. So you don't actually have to make a payment until you hit your limit on your line of credit. That product is very common for people that really want to ratchet this up and try to maximize the tax deductions. But generally speaking, most people are just making their interest payments from their cash, their own personal income and whatnot. A question here or a comment: a line of credit is always at a higher rate than a principal mortgage. Yes, that's correct. So what clients often do is they'll set it up so that any money that you're expected to borrow for an extended period of time, you usually lock that into a mortgage. So if I had a mortgage for my own personal residence and then I had a line of credit, and then I wanted to buy an investment property and I needed $100,000 for that, I'd probably advance the money in the line of credit for closing and for all that. And once all the dust settles after I close, I'd probably lock in that 100 grand into a mortgage component. So now I have my own personal 200 grand mortgage. I've got another 200,000 or $100,000 mortgage here, and I still have my line of credit with some extra room available on it. And then in the future, I could do another investment and then borrow money in the line of credit and then lock that into a mortgage too. And then you have multiple different mortgage segments, and it makes it easier for you to go to your accountant and say, this portion is not tax deductible. This one is tax deductible and it was for this investment. This one is tax deductible, it was for that investment. Makes it a bit easier to track it moving forward. So the line of credit is a higher rate, but it comes with more flexibility. And then if you're borrowing money for a longer period of time, then usually it just makes sense to lock it in. Yeah, so Graham, there's other tax savings for mortgages. Most of the other tax savings strategies are a little bit more based on the customer, for instance. So usually this kind of depends on the borrower. In some cases, so what we do find is we have clients that come to us that have an operating company and a holding company, as an example. One of the strong tax strategies here is if you have an operating company that generates a lot of surplus cash, one of the biggest things to look at is how do you try to minimize your taxes? Because if you take all that cash out of your business, then you have to pay personal income tax on it. And so let's say that you had 100 grand in your business and you wanted to use that for investing. If you took it home and you pay personal income tax on it, your tax bracket might be 40%. So you might only have 60 grand left over to invest. Now, most people, when they have this structure, they'll actually set up a holding company, and there are ways you can move the money from the operating company to the holding company in a tax efficient manner. Usually you're just paying the corporate tax rate of about 11% tax, depends on your tax bracket, of course. But you can move the money over to the hold company. And now what is happening is if you only pay 11% tax on it instead of the 40%, now you have 89 grand left over to invest through the holding company. And so in many ways, if you're an incorporated person with surplus cash being generated in the business, then setting up a holding company to then purchase the real estate is usually a strategy that makes sense. The challenge of that, Graham, is it's hard to recommend that to everybody because there is a lot of different nuances on whether you should be buying in a company name or not. And usually what we end up doing before we give that kind of advice is we look through the borrower's financial statements to see what that looks like and their overall picture. Sometimes qualifying in a company name can be harder too. And so there are different things that can be a little bit more difficult with that. I would say that most of the tax strategies really just come down to whenever you're borrowing or whatever you're investing, borrow the money whenever possible. And then on your non-tax deductible debt, you want to be paying that off as quickly as possible. So take all income from all sources, investments, from your rental properties, et cetera, pay down that personal non-tax deductible mortgage. Your line of credit limit would increase and you borrow against that to then invest in whatever investment you want to do. Let's check the chat as well. Let's see here. I don't think I have any other questions in the chat. Any other questions? Anything else that anybody wanted to ask? There's a question here from Joseph. I have an opportunity to buy a cottage in the interior of BC for about $900,000. I earn about $100,000. So really depends on the situation here. So I think we'd have to take a look at numbers and just see what opportunities you have to be able to qualify for that. I'll give you just general comments on borrowing power, et cetera. So usually you can take your income and multiply it by about 4 to 5 times. So for somebody that makes 50 grand a year, they qualify for about a $200,000 to $250,000 mortgage in general. If you make $200,000 a year, then you'd probably qualify for an $800,000 to $1 million mortgage. So if you wanted to buy a property that was close to $1 million, you'd either need a large down payment, or there'd have to be a lot of rental income coming from the property, or maybe look at getting a cosigner or something like that to help out with it. Yes, so we're going to have a recording of this, and then we'll be sending it out. So anybody that registered for the event will be sent a recording once the recording is finished. So that will be sent out. And so feel free to check that out. Also, we post all of these on YouTube as well. Awesome. Any other questions? Well, if you have any other questions or anything else comes up, please do reach out. Happy to chat. Hope everybody has an awesome summer, and hope to see you guys back in about a month for the next webinar. Talk soon, everyone. Thanks a lot.